So AS10 property, plant and equipment. It's a very important accounting standard, both at IPCC level as well as for CA final level, not only for accounting but also for audit, auditing paper. So this is very important for your ensuing examination in November 17. In May 17, there was no trace of the question on PPE. Originally we had AS10 fixed assets and we were having AS6 separately. Now these two accounting standards got integrated into AS10 new property, plant and equipment. Okay. So what are the principal issues that they take up? Principal issues are as number one, recognition. 2, they talk something about as how carrying amount will be reflected. Then lastly, they talk something about, they discuss something about depreciation and impairment loss. Impairment loss is only incidental. The main issue is depreciation, because impairment loss we have taken up separately in AS28 for discussion. Okay, and this accounting standard includes certain, excludes certain. Are you making notes simultaneously? Make a note simultaneously. Say this AS includes biological assets that are bearer plants. Excludes number 1, biological assets that are or other than bearer plants. What is a bearer plant? We will discuss later. And wasting assets. AS includes biological assets that are bearer plants. Okay, what is a bearer plant? See, whatever that is being produced in industries, in some of the cases you would have the inputs only from agricultural side. Example, sugarcane is an ideal example where agricultural produce is being the input of the sugar plant, and there are a lot other food industries where their main input is only from agricultural side. So there can be a company which may be having agricultural produce as their input. They may not buy. In fact, they would have their own bearer plants. Example, so our company is doing this coconut oil. So if coconut oil is the output, the input should be coconuts. So there are two ways of doing things you have. Majority of the companies, they buy. So that will not restrict them from having their own grow. So where they can have their own plants which will generate the inputs required for their output. So therefore, how is that we will consider for such oil company? I don't mean this oil and natural gas. I am talking about an oil being taken up, that being coconut oil. So definitely the coconut grow what they have should only be considered as property, plant and equipment, provided it is fitting into the definition, or whether it is satisfying or not, we have to check up. And if the conditions are satisfied, then it will become bearer plants. Are you understanding? There are variety of examples that we can give. We need not concentrate only on this bearer plants. Bearer plants will also be included, which is a biological asset. Other than this bearer plant, no biological asset will be included under property, plant and equipment. Are you clear? What is bearer plant? Have you copied up to this? Right. Bearer plant used in the production or supply of agri produce. See, even this tea, coffee, rubber and all that, what we have in income tax, are also having the characteristic feature of both agri as well as business. So definitely those items are also to be considered as bearer plant only. Expected to bear produce more than in a period of 12 months. This is something similar to the what we have discussed in the case of AS 16, where the substantial period of time is considered to be 12 months. Here they have mentioned it 12 months clearly. There they have said it can even be altered depending upon the type of industry and all that. Here it is not like that. They have just conveyed it more than 12 months. It will be expected to bear the produce. Has a remote likelihood, that being chance of being sold what is that? Has a remote chance of being sold as agri produce except for the incidental scrap. Incidental scrap. The following are not bearer plants. A. See, the tree is what they call it out as a plant. So don't dispute in this particular case. Sir, they have used a term as plant, but you are referring about a tree. So plant is a general biological reference that they have made. Plant includes trees also. But what is that? We normally will consider plant means the smaller ones before it just achieving its what I would say adulthood or the maturity. So we will call all these as plants. Plant itself being an agricultural produce. lumber. See, this cricket bat is also drawn, and we call that as lumber only. The bat, what they just make it out from a wood. Generally, the trunk portion we call it as a lumber. Annual crop such as rice, wheat. See, within a year, whatever that you have it, you put it as annual crop. These items are not bearer plants. So the focus is not on to bearer plant. Just for the first time when we hear all this in accounting standards, we thought we will just devote this time. Now the main area is coming up, PPE. PPE is firstly, we should understand that is a tangible item. What is a tangible item? Held for use in production or supply of goods and service, then rental to others, then held for admin purposes. The next one, expected to be used for a period, expected to be used for more than one period or more than 12 months, we can say. Expected to be used for more than 12 months. So there can be a short notes question as what is PPE. What are the very important things that you have got to understand? Firstly, you have got to tell that it is tangible, held for the purpose of production, supply, for rental purposes, and for admin purposes. You can easily remember in a cost sheet we used to have production overhead, then selling and distribution overhead, administration overhead. So in the first case, production and supply. Second one, rental to others. Third one is admin purposes. And then, in order to say that it is a capital item, it should be used for a period more than one. So a period would mean automatically it become revenue expenditure. In order to have a capital expenditure definition, it should be used for a period more than 1 year. That is what we have got to understand. Then, cost of a PPE. So, is that we have done AS 26? Yeah, not done, no. See, because morning batch we are having class, there I just completed. So, for me, I am not sure as where I completed. So, a particular usage of term I will be making here. So, cost of a PPE shall be recognized as a capital, that is as an asset, only when it is probable that future economic benefits, FEB, future economic benefits will flow to the entity. Probable, the cost of a PPE, where the entity will be probable or will be expecting that future economic benefits will flow to the company. What is future economic benefits? Future economic benefits need not necessarily be in the form of cash. Benefit is what they are saying. So, benefit can be measured in various forms. The expenses reduction is also a benefit. Facilitating a function is also a benefit. So, benefit can never be equated with cash flow. So, future economic benefits will flow, and cost of the item can be measured reliably. whether a spare will be capitalized, whether a standby machine will be capitalized. If a question is asked, we have got to tell that spare as well as standby should also meet this definition. What is that? If that spare is likely to generate future economic benefits and cost can be measured reliably, if yes, this is a double condition, okay, not single. You have to have both. Both the conditions should be satisfied. If the spare is also satisfying this condition, then it can be capitalized. If the spare or the standby, whatever you say, is not meeting this definition, then you cannot capitalize. So, spares, standby machines shall be capitalized provided they satisfy the above conditions. Provided they satisfy the above conditions. Make a note immediately, okay? Then, this is for the initial cost. Subsequent cost. What is the subsequent cost? Subsequent cost area is classified into three. One, day-to-day expenses, replacement and major inspection. They classify subsequent cost into three: day-to-day expenditure, replacement and major inspection. They classify that into three. Day-to-day expenditure to run the machine. So, see, if you buy a machine, say that being a Xerox machine for your office use, so day-to-day expenditure that you are incurring, power, then paper, consumables, all these cannot be considered as for capitalization. They are to be expensed. They are to be expensed. Replacement of parts. Then what is that we should do? Replacement of spares. What is that we should do? In AS10 old setup, since it is coming up as replacement, it should be expensed, is what we have studied there in the old setup. Now you don't have that. You have exactly the opposite. What is that they say? It should be capitalized. Not only that, the carrying amount of the replacement, that is the spare which is there, that should be derecognized. It is not simply you can accumulate all these replacements. It is not a dump yard. What is that you should do? The earlier one which is getting replaced, whose carrying amount should be derecognized, and the new replacement spare should be capitalized. So two things you should remember. Spare getting replaced, that is the old one, shall be derecognized. New spare shall be what? Capitalized. Now, people will come with an argument. See, people will normally be saying it is not possible. If you say something, sir, I bought the asset as a whole. I didn't know that the value of the spare that I am replacing. But I know the new spare cost. Am I right? Are you understanding the argument? People might just say, sir, when I bought the car, I just bought the car. I didn't know that this particular spare is going to cost so much. I have included in the total cost of the car. Now you are saying that you have to replace. You say that old item should be derecognized. How am I going to identify this spare in the whole cost? So you only capitalize, but I cannot derecognize. Might be an argument people would be placing because they don't want to do more job. Correct? No. So in our office we do have a particular way of billing. Way of billing would mean if a client is having capital gains, his fees will be a little different. Even for a salaried person, whether capital gain is negative or positive, we are not really worried. So there is one fees. If the client is going to have futures and options, then it is not capital gains, it will come under PGBP, and in majority of the cases they will be booking loss, and that loss when they book, then they will be covered under tax audit also, because turnover definition itself is different for them, and we will be finding out turnover in a very unique way. Why? Because if you ask me a question, sir, why is that even client is earning that much of money, what is the stomach ulcer that you have, why do you charge more? It is not stomach ulcer, we have to do extra work. So in the statements, we have got to find out in which quarter he is selling, and quarter wise I have to give details. So if I don't have capital gains, I can bypass that, I can finish off my work faster. There will always be a logic behind why an extra charge is there. So one client, 10 bank accounts he is having. For him, a tax audit rate only we have fixed. Because to fill 10 bank account in pre-filled forms, you don't get it. I hope that you people just know how to do that. So therefore, extra job, extra fees only. We can't be just charging the same fees for all. For businessman, digital signature, all this, it all depends on the turnover and what sort of risk that we are taking, isn't it? People will always be telling, sir, what is the problem for you? These are the difficulties. People would just express their difficulties. One of the difficulties is that when I buy as a single unit, by paying the price, I didn't know this spare amount. Can you just leave it off like that? Say, sir, no. Can you leave it off? Sir, he is not in a position to find out the old item who's carrying amount. It is there in the entire system. How do I know that this spare is going to be the carrying amount like this? Are you understanding? See, it is something like God sent all parts to you in this world. So a person underwent kidney transplantation. So the old kidney is taken, new kidney kept. What is the carrying amount of the kidney that you have replaced? What is the cost of the new kidney that you have placed? How do you identify? That is what I have asked you. That's the question. How do you identify? Have you understood the question? How do you do that? Because that sort of question is going to come. You tell. Proportionate. Either which proportion? On which basis you will take proportion? Accounting standard has given you one wonderful thing. See, people will have this problem. It is all God sent, all parts kept correct only. Because this person did not use it properly. Drinking and lost kidney. All his family members were into great difficulty. Somebody had just close relative came for replacement. Now, what is the old item you have to remove? So, in God's sent, what is that value? Likewise, in machinery, you cannot be identifying the spare. What they say is that you take up today's spare price. 6 years back you have used, no? 6 years back you have used, that is bought this new machine. So, if it is 45,000 today, this new spare alone, because the person who is giving you the car, he will not, there will be thousands of spares there to make that car. For individual item, he will not be quoting this is the price. He is going to quote 25 lakhs. You have bought all the spares, all of them are in running condition. So what they say is that 6 years back you have bought, so the spare value is known to you. 6 years back, what could be the value? You can use PV factor and find out the value. So here in new AS10, if something is not possible, you will not be allowed to proceed further. It is all something like compulsory field that you have got to update. That means you cannot proceed further. In e-filing and all that, compulsory fields, if you are not updating, your return will not be uploaded. It cannot go. It cannot go. Are you understanding? So, You see, there are a lot of challenges. Tomorrow is the last day. One system went crashing. So, a lot of tally files are there. So, we have just called a hardware fellow to make it up this evening. So, அதனால காத்தால கிளாஸ்லாம் கேன்சல் பண்ணிட்டு முடிச்சோம் ஒரு வேலையை முடிச்சிட்டு வரோம். So, in fact, this class also I wanted to cancel, but tomorrow I have to make it up. No leave for our articles persons today. So, you know how to do. There is no, what should I say, nobody will be spared. Oh, this person is not knowing the spare value. So, therefore, we will give him exemption. There is no such exemption at all. So, what you do is that present spare value you find out. 6 years back when it was bought, use some PV factor, take up some 5%, 10% cost of capital, find out that value. And that value is what you have to remove from the books, and new value is what you have got to take up. Are you understanding, all of you? So, in case it is not ascertainable for removal, that is, in case it is not ascertainable to find old spare carrying amount, use PVF and apply on new spare price so as to estimate the, in case it is not ascertainable, to find out old spare carrying amount, use PVF and apply the new spare price. So, even that itself is enough. And apply on the new spare price. That is what you have to remove from the books. Are you understanding, all of you? So, the PVF is, say, 5% or 10%, something you decide. There you have to bring out an assumption and then proceed. No, this is a new spare, no. There is a question of depreciation. You can understand, just wait for that. It is not for the cost for the item that I am talking about. You take into account all this in your PV factor itself. That itself will factor it. So, your question is that you are trying to find out what was the cost at that point of time. So, what could be the depreciation rate, whether you would have taken up useful life for the full 10 years or only for the 6 years. So, all that you will have more and more complication. So, at this moment you want to know the old amount to be re-recognized. So, use this and remove that and add to the existing asset the cost of replacement. Okay. So, new spare shall be capitalized. Major inspection, same as replacement. Same as replacement only. Same as replacement only. Okay. Then what are all the items that can be taken for capitalization? Generally, from AS10 old system, you tell me what are the items that you will be taking for capitalization. In AS10 fixed assets, it's not that we are learning the principles of capitalization only today. We have already learned. Could you tell what are the items that we have to take up? The purchase cost you should capitalize. Then there is, I would say, items to be included, excluded. Purchase price, then Borrowing costs, you can tell it a little later, no? So that which is associated with that. Freight charges, insurance charges. Test run costs varakuda. What is that? Test run undi varum. Say trial run charges la varadu. There is always a difference between test run and a trial run. So then example then kekra. Example kekkumbodhu you can just provide more, no? Site preparation. What do you mean by site preparation? There may be an existing ground, so you have to put some mounting on that. So though it may not be related to directly onto the asset, so these are all site preparation, initial delivery, handling charges, installation charges, then assembly, cost of testing, consultant fees, or you can call that as a professional fees. Then what are the items that we got to exclude? Examples: cost of opening new facility, then cost of introduction of new product or service. Next, business promotion. Admin and selling and general overheads. See, sometimes official launching may not be there. Official launching may be by August 23rd, let's assume. Now itself they will be taking up orders, but they will give it at 50% of the price and all that. Say, you would have just seen, it could be a amusement park. So there are a lot of facilities, they are under construction. So some 60 to 70% of the programs may be available. Remaining 30-40 they have to complete it. That point of time itself they will be opening it up to the public, but they may not have given a very big advertisement. So 50% of the normal fees at which they can bring customers. If that be the case, then what is it we should be doing? Whether we can give credit or the expenses incurred for that particular operations, can that be capitalized? Are you understanding? See, you find an amusement park or whatever may be the thing that we are talking about, may be launched 1 month later. So subject to some 20-30% completion is there. So the remaining facilities are there. So you open up that and make a billing, but you don't. But you are saying that by 23rd of August only you are going to launch. So if that be the case, there will be some cost that you would be incurring for operating it. Some revenue also will be collected. What shall we do with that cost? What shall we do with that? So the cost should not be added, income should not be deducted. That will be taken straight away to profit and loss account once an asset is ready for its intended use. Even at the stage when it is 70% complete, when it can be put to use. So you have to stop all your capitalization, and thereafter for the remaining 30%, what you have to finish, that will be taken for capitalization. But the operating cost and the incidental income cannot be taken as any part of your cost of the asset. That should be taken to profit and loss account only. So, what is that we can say? Initial cost of operation and revenue before official launch. Official launch. This will be taken to P&L account. Okay. Then similarly, initial operating cost. Here is a place where you do a lot of experiments. Testing is different from doing these initial operations. Yeah, operating loss or cost. Then cost of relocation. These items are not to be capitalized. These items are not to be capitalized at all. Next one. Are you clear about this one? What should be capitalized and what should not be capitalized, you should be knowing. Then, about self-constructed assets. Self-constructed assets. What do you mean by self-constructed assets? So, you develop your own asset there, you bring the technician, you buy the material, ask them to launch it. That is, ask them to construct it. So, that point of time, there can be some services you find other department may be rendering for the construction, and if in case of any internal profits, we are expected to eliminate. So, we have a concept called as transfer pricing and all that. So, in transfer pricing, one department when it is rendering service to another department, they will do it at cost plus some profit. So, we are very particular in case of self-constructed cost, self-constructed assets. Such internally generated profits are to be excluded. So, just like any other asset, capitalization should be on. Eliminate internal profits. Also exclude abnormal waste, etc. See, what could be an abnormal waste? You just construct in one particular model. One consultant would just say, no, this you have to demolish. So, previously what you would have capitalized, you have to eliminate. Why you need to eliminate? Because that is not going to be the part of the asset. You can't be capitalizing whatever you want to, whatever money that you are spending. So, it is not that way you can take it up for self-constructed assets. Also exclude abnormal waste, etc. So, you have got to be very careful with doing this. Then next. Okay. Then PPE, where you can buy, that is you purchase. The next one is you exchange. You exchange between the one that you are having. That is, I have asset A, you have asset B. So, I would part with asset A and take up asset B. So, what are the values at which they are to be taken up? That we will take it up. The next one. So, how we will handle finance lease? How we will be handling in the case of consolidated price? How is that we will be handling finance lease? How is that we will be having government grant? These are the areas we will be discussing. Now, PPE, you buy one asset. what price you pay, that is the cost. Agreed? Supposing if it were to be exchange, then what is the figure that we are going to take up into our books? I have asset A and I am giving asset A and taking up asset B. What is that we have to do? See, this is purchase, very ordinary one. So record at purchase price. Supposing if there were to be any finance cost or any interest cost, eliminate that interest cost. Eliminate interest cost. Supposing if it is on deferred payment basis, interest cost shall be eliminated unless it is required as per AS 16, where borrowing cost should be capitalized. In exchange, what is that we are expected to do? That's all we have done in the old system. Come on. See, what do you mean by exchange? Exchange would mean giving up one and taking up the new one. So it should be recorded only at the fair value, unless the exchange by itself is not in substance an exchange. So I would put it this way. There can be another type of exchange also possible. Only then you can understand that there are two types of exchanges we have. A person who is having a high-end car, he had used it for say 4 years. It has got a carrying amount and it has got a fair value in the market. So the authorized dealer of that particular car, when the car has come for servicing, he promoted the idea of a new car to be exchanged. The carrying amount is, say, let us assume 13 lakhs, and the new car is available for 13 lakhs and 25,000. The new car may be a different model. High-end car, WDV, now what he bought at 25 lakhs some 4 years back, now it is 13 lakhs as per books. There is a smaller version of the car has come for 13 lakhs and 25,000. Okay. Since it is a customer loyalty program and exchange, he said, you take free of cost. What is that? You take at free of cost. If you have to buy, you have to pay 13 lakhs, 25,000. So it is a customer loyalty program, exchange program. And the old car is also in good condition. He is saying, dealer is just telling, okay, I will just give you bag of sweets and petrol tank will be full or diesel will be full, fuel will be filled, and with all this extra fitting, he is giving it. That is not really an exchange.